Welcome to Policy on Demand. I'm Sindhu Blume.
And I'm Scott McCandless. It is the week of December 16th, and this is your Monday briefing.
Before it adjourns at the end of this week, Congress will need to pass another short-term FY25 federal government funding continuing resolution, or CR, before the current temporary funding measure expires this Friday. The CR could extend the funding deadline into March and could include additional emergency disaster relief funds.
The Senate also is scheduled to vote this week on an annual national defense authorization bill that was passed by the House last week. In addition, there is interest in possibly taking up a bill to provide relief from double taxation between the United States and Taiwan. On Wednesday, the Joint Economic Committee will hold a hearing on trade and tariffs, and the Federal Reserve will announce an interest rate decision.
We have a lot to talk about today, starting with the accounting of currency fluctuations, with last week's release of final and proposed foreign currency regulations. And joining us to understand the new guidance is Laura Valestin. Laura, welcome.
Thank you for having me.
So before we get into the details, the premise behind these is to deal with challenges that companies were having to account for currency fluctuations. So these final and proposed regulations came out. Tell us what they do.
The big picture is these rules are all dealing with providing rules for how to account for foreign currency translation gain or loss that arises when you have a qualified business unit, referred to as a QBU, that operates in a different functional currency than its owner. So that's just who it applies to.
Okay.
So the proposed regs came out in November of 2023. To what extent does the most recent package retain some of those original elements?
There's actually a lot of the basic structure that's retained in the final regulations. So kind of the main drivers or the main things that were kept is you still have the FEAP method, the foreign exchange exposure pool method. You still have the simplified elections that they were providing in the proposed regs, the current rate election and the annual recognition election. So thankfully, those are still there for companies. It does still include a lot of companies that were previously brought in the 23 proposed regs. So our banks, your insurance companies, your RICs, your REITs, these are still included in, and they have to follow these regulations. There is a retroactive piece to it, to terminating QBUs that terminated anytime on or after November 9th of 2023 until the regulations are final. That rule is still there and applies to terminating QBUs. Pre-transition gain loss calculations are still required. So any of the historic 987 gains and losses that companies had, that still gets carried forward into these new regulations. And our suspended loss rules that kind of popped up new in the 2023 proposed regulations. Those rules are still there, although there is some modifications to them in the new regulations.
So those are items that are retained, but what has changed from the November 2023 regs?
So there are lots of changes. I'd say one welcome change is that these new final regulations generally do not apply to partnerships and to S corporations with respect to how to account for 987 gain or loss and how to compute taxable income gain or loss for the partnerships or the S corps. However, there are certain provisions in the final regulations that are still going to apply. So things like the suspended loss rules, the deferral event rules, the character and source rules, those all still apply. So for partnerships and S corps, while you can still compute kind of under the method you were using historically, you still have to be aware that some of these new rules are going to apply going forward. Then you've got a welcomed mark-to-market election. So right now, there was a 988- under proposed regs, 1.988-7 election. It allowed you to mark-to-market all 988 transactions, but it did not apply to 987 QBUs. They added a 988 mark-to-market election in the final regulations. So you can do that, mark-to-market election for your 987 QBUs. So that's quite welcomed. They also changed the rules. It used to be that 988 transactions were determined in the functional currency of the owner, which is not what accounting does. And so the government took, the comments to heart, and they changed the rule back to say that 988 will be determined at the level of the QBU, which again is consistent with what financial accounting does. They've also provided some simplification in terms of how to compute 987 gain or loss under the current rate election. There was, obviously comments about tax basis balance sheet reporting and how that can be difficult. They did take those comments, and so they provided a simplified version that kind of is akin to 1991 type method of looking at transfers in and out during the year and taxable income. And that similar simplified approach can also be applied if you're using their default transition rule now in the final regulations. So there's some simplification there. And they also, again, welcomed change. It used to be that if you were bringing forward your pre-transition gains and losses, you'd have to go all the way back to the inception of the QBU. And you can have QBUs, right, that are operating for 50 some years.
Right.
Too complicated, the information's not there. So the rules basically have said, look, what you can do is if you don't already have an existing methodology and you now have to do this default calculation, you do not have to go back to the inception of the QBU. You can go back to essentially taxable years that begin on or after September 7th of 2006, which is when their 2006 proposed regs came out. So again, for calendar year taxpayers, that means going back to like 2007 and forward instead of however many years back, right?
Yeah.
So again, lots of good news here. The last one is, they put out a final and proposed package, and in the proposed package, they included some proposed regulations that are going to help reduce the burden on frequent reoccurring transactions, disregarded transactions in QBUs. So again, a welcomed change in proposed form. So again, they're looking for comments on what to do with those proposed regulations.
Right.
But a lot of good news, I think, in the regulations.
And finally, Laura, the rules seem to apply in general to tax years beginning after December 31st, 2024. So what are some action steps that companies might want to think about as they prepare for that?
Yeah, great question. So I think what companies need to think about, it came out right at the end of the calendar year, right? So a lot of companies, that's going to be provision time, and they're thinking about, what do I need to do my financials? So one thing is to think about and talk with your tax accounting folks as to what, if anything, needs to be done for your provision. Then you also need to probably identify the population of 987 QBUs that a company has and figure out, is there an eligible method they're already on that they're going to use to transition? If not, then looking back at what's the pre-transition calculation going to look like and getting that information. And then kind of thinking forward to 2025, you have to think about the elections. Probably modeling out and considering what elections, since there's lots here in these regulations, what elections, if any, does the company want to apply? And then those can be made with your 25 return.
Great advice. Thank you very much for your insights, Laura. Appreciate you being here.
Thank you.
Thank you so much.
Thank you. In the description of this episode, look for links to our most recent Week in Review with Janice Mays and a special episode on new research credit forms the IRS plans to release soon. You'll also find links to register for 2 tax readiness webcasts happening this week.
And a programming note that this will be our last Monday briefing of 2024. Thank you as always for joining us, and we hope you have a great week and a wonderful holiday season. Take care.